We'll go to the markets here as we watch the first trading day of a new week, and we're modestly green. The dust now settling from the rate cut, which leaves us, Joe, where? Goldman Sachs' David Kostin today raising his 12-month S&P target, raised a few of them, but the 12-month target is now 7,200. It is Goldman's Tony Pasquarello who makes the call I referenced at the top of the show today, too. Don't fight it, don't chase it. Do I love the positioning setup and tactical risk reward? I don't. With that, do I think you should be stepping in front of the U.S. mega cap tech freight train? I don't. It's a bull market. The primary trend is higher. I feel like this matches with the Tepper view, Joe from Squawk last week. Don't really love the valuations that we're trading, but I'm not going to stand in front of this market, not with this Fed, not with fighting the Fed.
Fully agree. And that's exactly, I think, the disposition that most people have towards the market right now. It's interesting because he says, don't chase it. Well, if you're already well positioned, if you're long like we all are the market, you're going to see that the work is going to be done for you as the calendar approaches the end of the year from a lot of people that are forced to chase it. They're forced to chase it because they might be underperforming year to date. So I do believe that chase for performance ultimately is going to happen. It's difficult to find opportunities. We'll talk about a couple on Thursday. I gave the XPI as a final trade. That looks like that's breaking out. And then I think if you look at the Mag 7, there's only two Mag 7 names that have not made an all-time high in 2025. That would be Tesla and Apple. Well, guess what they're doing right now? They're going back towards those highs that they traced out earlier in December. So I think there's some opportunity, very strong momentum in those two names right now.
I mean, the XBI is up 2% since the rate cut. We're talking really only 2 full trading days, last Thursday and Friday, as we know. What about this, Steph, from Pasquarello? Don't fight it, don't chase it. Yeah, I mean, I don't think the best investors in the world, they look at the market, they see the valuation, they're like, I don't really love it. But, man, this AI theme is powerful, and the Fed's cutting, so I'm not an idiot. Like, I've seen what happens before. I've seen this movie before, right? Maybe a few times before. I'm not going to get in front of that.
Well, the Fed is cutting into a strong economy, so that's actually very powerful. I would say, yes, the market is expensive, but you're going to see double-digit earnings growth, free cash flow growth of 14% year over year. Companies are buying back a ton of stock, and you have margin expansion. So I actually think we're probably just going to sort around here for a couple of weeks until earnings season, and on the 14th of October, that's when it all starts again, earnings season with the big banks. And I went back and I added up all the buyback news from the banks, the big six. They still have 192 billion left to buy back stock.
I can't believe
that's powerful.
That earnings are that close.
I know.
Feels like the earnings season kind of just ended. Now, here we are in October. We're going to be doing it all over again. By the way, since you mentioned buybacks, it's a great setup for if you consider what are the next legs of this rally, where does it potentially come from? Well, JP Morgan notes buybacks, which Steph was just talking about. S&P companies have announced buybacks at an unprecedented rate. Close to $960 billion committed year to date, significantly surpassing the 3-year average of $644 billion. $960 committed year to date. 3-year average, 644. That doesn't give you an idea. Your financials, Charles Schwab, Bank of America, Morgan Stanley, and JP Morgan have all announced buybacks.
Well, and Uber is going to buy back $20 billion, and that's 9.5% of its float. I mean, so this is really material. I think that the banks are going to hit off the earnings season really powerfully. I think they're going to be very, very strong. And then we get into that, what I call silly season. So, yeah, you don't have to chase. Silly season is when a company reports good numbers and the stocks fall, and numbers are still going higher. That's your opportunity. So that's what I would say. Wait until earnings season. I do think, by the way, the $7 trillion of cash in money markets will come, not all, but some of it will come and will be a tailwind as interest rates come down, because you're not getting 5% on your money markets
Let's
anymore.
debate that, Sarat, because that's been a key point from some. That look at all this money that's still on the sidelines, going to come into the market now because the Fed is going to do its thing, and that's going to be good for the market as well. Maybe not. Wall Street Journal today says investors are flush with cash, excuse me, and happy to keep it there. Assets in money market funds reached a record $7.7 trillion last week. Pardon. Surratt, take it away. Can't you see?
So let me take it from you while you get your water there. So I think Steph's absolutely right here. So what's going to happen is rates start coming down. Investors are going to say, wait, my 3, 4, 5% money markets, I'm not really going to get. So at that point, what am I going to do? I'm going to put money back into the market, and I'm going to look for opportunities, because even fixed income today, spreads are the tightest that they've ever been. So you're not going to be chasing that. So you're going to go back into equities. And the equity point that we were talking about, you have two things going on. You have a put basically with the Fed, because if things start slowing down, they're going to cut rates faster, and buybacks are going to accelerate. So that's going to also help the equity market. So I think you've got three positive things going into whether you get good or bad news.
I want to push back a little just on the premise that the cash coming into the market is such a big catalyst. It seems as though that cash has been sitting on the sidelines since the great financial crisis. Maybe there's so much cash in existence because the world is just getting wealthier. So I really think it's about what Steph mentioned before. I think it's the profit margin expansion, because the profit margin expansion is the solution to offsetting the tariffs. The profit margin expansion allows you to buy back your stock. And I think as long as that profit margin growth is there, where we went from 12.25% to 13.5%, as long as that's present for the S&P 500, then I think for sure we are in a really good position. And I don't think you need that quote unquote cash coming in from the sidelines.
I think it's nice to have, though.
What if people?
It's nice to have, but I think people keep making that argument. And I don't think you should sit there saying to yourself, okay, I'm going to rely on the cash coming in from the sidelines.
3 years ago, you didn't get 5% on the money market. Now you're getting 5%, and now it's going to come down gradually if the Fed continues to do what they're doing.
By the way, rates are up since the rate cut.
They are. 3.98 for a 10-year on Wednesday.
Yep. I know.
They're still up.
The 30-year fixed mortgage is down 100 basis points from January.
Then tell me why the home builders are down 1.5% since the rate cut.
Because they were up 30% from the second quarter earnings report.
So it was all pull forward?
I think a little bit of it was a pull forward, and they can take a breather, but they are still extremely cheap. We haven't had a housing cycle, and we're still growing the economy at 2.5%, 3%. Imagine when we get a housing cycle.